Having too much money tucked away in pre-tax accounts may lead to paying extra taxes, both in your lifetime and beyond. If you have more than $1 million in your 401k, you may need tax planning more than you think. In past Retire Mentorship podcasts, we've discussed how new and complicated the retirement math problem is. To jog your memory, if you're turning 65 this year and started working at age 20, you are a member of the first age class to have access to a 401k for your entire career. That is, the 401k is just 45 years old. And while you were focused on your career and saving for retirement, the IRS introduced the Roth IRA in 1999 to be exact. That is, the Roth IRA is just 26 years old. So how does that play into tax planning? Well, the interaction between pre-tax, the traditional 401k or IRA accounts, and post-tax or Roth accounts present a tremendous financial planning opportunity, but technically it's a tax planning opportunity, and not everyone can offer tax planning. Unfortunately, most tax filers are so focused on filing annual returns that they want to maximize current year refunds, and they don't do much, if any, tax planning. Some have even objected to some of the mathematically justified long-term tax planning strategies that are recommended by certified financial planners. And technically speaking, certified financial planners aren't allowed to give out tax planning in the form of tax advice. CFPs are allowed to offer a tax education by illustrating scenarios in the form of recommendations and then telling you to go follow up with your tax preparer. But rather than using a loophole to offer tax planning, the best approach for tax planning is to find a CFP who also holds his enrolled agent designation, as we do here at Lacrosse Financial Planning. This way, your CFP can offer legitimate, straightforward tax advice and not resort to loopholes, while also getting your annual filing taken care of for you as well. But back to the 401k and Roth discussion. No one wants to pay extra taxes, right? If you have over $1 million in your 401k, you will likely have a sizable Social Security benefit, which will be a decent income in retirement. This means that a considerable amount of your retirement income will come from your paycheck from Uncle Sam and reduce your dependency on your 401k. But this can lead to an issue. Since retirees aren't forced to take distributions to cover their living expenses, the next time they're forced to take distributions will come when they reach the IRS-determined age that triggers required minimum distributions. RMDs, as they're known, must start at age 72 or later, depending on your birth year. But the key element of RMDs is that the IRS requires that you take a portion of your 401k or IRA as taxable income at some point in the future. And the amount you take is based on your age and the account balance. With 7 or more years to grow between 65 and 72, and with limited distributions because of a reduced dependency on the pre-tax account for retirement income, these balances can swell before retirees reach RMD age. These big retirement accounts can generate big RMDs that push retirement income into even higher tax brackets, which means Uncle Sam gets a larger portion of a larger distribution as the accounts grow and your age increases. So how do we avoid overpaying these taxes as RMDs force us to take extra taxable income in the future? Easy. Roth conversions early in retirement. After retirement, you have the option to move your 401k to an IRA. And from an IRA, you can convert to a Roth by taking a perfectly calculated amount of pre-tax money and filling up the right amount of tax brackets with a taxable Roth conversion. Roth conversions will serve 3 purposes. 1, they will reduce the amount of RMDs you'll need to take later. The IRS wants their share of taxes that haven't been collected from IRA funds yet. But RMDs will force big distributions and big taxes on big IRAs. But by converting IRA funds early in retirement, rather than waiting for RMDs, we control how much we pay in taxes by converting early in retirement. For example, rather than waiting until 72 and having RMDs force us up into the 24% tax bracket, you may be able to convert in the 22% tax bracket and only the 22% tax bracket for the duration of your retirement, since the account balance will be lower later by converting to Roth now. This can save married filers hundreds of thousands of dollars over their lifetime. The second benefit is that Roth conversions increase Roth funds. Intuitively, Roth funds grow tax-free and can be distributed tax-free. But this can only happen 5 years after the conversion takes place. But once available, you can take as much as you want from the Roth IRA tax-free, which means we can distribute Roth funds without worrying about Uncle Sam's cut or overpaying in taxes. Since Roth funds reduce our dependency on the pre-tax IRA funds, we are free to execute future conversions up to a certain tax bracket with complete control over how much comes out without the IRS telling us to do so. And we avoid those higher tax brackets once again. Finally, Roth conversions reduce taxes for beneficiaries. This is a big one. 30 years from now, your beneficiaries will inherit your accounts, and without Roth conversions, they will inherit only pre-tax IRA money. Current law dictates that beneficiaries have 10 years to distribute funds from an inherited IRA, and how old your beneficiaries are going to be in 30 years is worth noting. How much growth your accounts will experience over the coming 3 decades is also of note. When we run this projection for clients, and they see that their 25-year-old children will be 55 when they inherit the IRA, and in their peak earning years, when they pass away, a light bulb comes on. There's only a 10-year window that we can distribute IRA funds from in an inherited IRA account, and beneficiaries will be forced to pay income taxes on IRA funds on top of their peak earning years of income, which will likely be at an even higher tax bracket than what you could have paid by completing a Roth conversion early in your retirement. It's worth noting here that inherited Roth IRAs have already been taxed, and while there is a 10-year rule, inherited Roth IRAs will not add to taxable income, so there's no tax bomb created by inheriting Roth IRAs, and one more reason why Roth conversions are so valuable. If you have more than $1 million in your 401k, you may not need to take distributions from your 401k to meet your retirement income needs. However, tax laws may force you or your beneficiaries to pay higher taxes later through RMDs or the 10-year rule for distributing inherited IRAs. The only way to know if Roth conversions are right for you is to actually run the calculation and projection to evaluate the optimal time to move those funds out of pre-tax retirement accounts and into Roth accounts. After all, we should always pay every penny we owe in taxes, but we should never leave a tip.
If you enjoyed that, you would love being part of our free membership community. It's called Retire Membership, and it has a host of benefits all for free. For example, you can always buy my book, 3D Retirement Income, on Amazon. But if you join us at Retire Membership, we will send you either a hard copy or paperback for free, provide the ebook and the audiobook so that you can listen to it if you don't have time to read it. In addition to that, we'll also provide you with a bunch of content that you can't get anywhere else. For example, we have our quarterly Retire Mentorship magazine, which comes out quarterly and has no ads whatsoever. It's just timely content to help you stay the course. We also have workbooks for our free online workshop to help you get the most out of those, flowcharts to help you make better decisions, and a weekly email to provide timely content that you can unsubscribe from at any time. We never ask for any payment information, and we never share your information with anyone else. We just want to provide timely content and help you stay the course to retire successfully and stay successfully retired. There's no reason to wait, so join us now at retiremembership.com, where you can click in the link in the description and it'll go right there. We can't wait to see you in the community. Cheers. This podcast is educational only and is not investment, tax, or legal advice.